Hello and welcome to Stockwatch, presented by me, Evan Lucas, for Go Market Securities. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none of which we relied upon as any form of personal advice. Go Market Securities does not know your personal scenario, nor your personal financial goals, and therefore none of which relied upon as any form of advice at all. It is just general in nature only. So it's official, the RBA will raise rates in 2022. I think that is exactly what you need to read out of the statement that was given for this Tuesday. And the reason I highlight that is that we no longer see the word patient. It has seen the Aussie dollar go through 76 US cents. And why am I talking about that in a stock scenario? Because you now need to start thinking and evaluating stocks that are directly impacted both positively and negatively by raising rates. We've talked about the banks before. We know banks actually do better because their loan book actually increases. They get a better return with those higher rates. So they will be ones we know that are positive. But let's today think about some of the ones that could be slightly negative. That are things like industrials. Those are that are high in debt and debt borrowings. They're the ones to also watch. Those that have reported to us in the last couple of weeks that debt is actually still large and getting larger, they're the ones to watch now because they are going to have to generate just that bit more income just to service what they currently have. It also means that the ability for expansion and growth stocks in particular are now also under a bit of pressure because part of the way they expand, part of the way they grow their business is to use leverage and therefore debt. There's nothing wrong with that. It just means that they now have to pay a little bit more to service that debt, and it could be significantly more if you look in somewhere like the US. All of those now need to be part of your thinking. And that is why you do always need to have some eye on the macroeconomics to understand what it means for your stocks. So yes, watch those industrials, watch those high debted companies, all those growth stocks that have used debt to service themselves. They've been great over the last period because of the rates that they've had. Now they're going to have to actually really justify their growth by showing and coming true with that growth on a revenue line and a net profit line as their debt levels go up.